Thank you, Mai, for the introduction, and thank you everyone for attending our Smart Investing Summit here. Good afternoon. Today I have the privilege of presenting to you our market outlook. Okay, so to start off, I'd like to tell you that the market is up by around 14%. Of course, since the time we first came out with this report or presentation earlier last week, the market has corrected a bit. It's now at around 7,800. Nevertheless, I'm sure that for all of you who have been following our presentations on a semi-annual basis, earlier this year, we were very cautious. And you're probably wondering what has changed since then and why did our cautious outlook did not materialize. Okay, so there are three reasons why the market actually performed so much better than what we expected. And I'll talk about them one by one. So the first one is the Fed's more subdued rate hike expectation. So earlier this year, when we first talked to you in 2016, we were bracing for 4 rate hikes for the whole of 2016. But as you know, it's now September, and the likelihood of a rate hike has gone down significantly, and the expectation is at most there would only be 1 rate hike this year. Okay, and that development actually has a lot of implications, a lot of positive implications. The first implication is, of course, emerging market currencies would be stronger. For example, the peso. I'm sure earlier this year, you were hearing people talking about the peso hitting the 50 peso to the dollar mark. But of course, right now, it's at 46, 47, right? And one of the reasons why it is that way is because the Fed is not expected to increase interest rates by 4 times. And another positive implication is commodity prices had recovered because of expectations of less rate hikes. And that is very positive for a lot of emerging market countries like Brazil, Argentina, and other commodity exporting countries, even in the Middle East. Okay, aside from that, the Philippine economy continued to surprise positively despite the negative outlook in the global economy or weak global economy. Our GDP growth surprised positively. First quarter, we had 6.9% GDP growth. Second quarter, it was 7%. We're actually now one of the fastest growing economies globally, against the backdrop, of course, of a lot of risks in the global economy. And finally, earlier this year, we were bracing for some weakness in OFW remittances. But as you can see, for the first 6 months of the year, remittances still continued to increase by 3.2%. Okay, we didn't see a drop as we had earlier anticipated. So we looked through the numbers. Yes, the remittances from Saudi Arabia have gone down. On the positive side, we did not anticipate remittances from places like Kuwait and Qatar to actually increase significantly, offsetting the weakness in Saudi Arabia. So very good news for us. We did not experience the slowdown that people were bracing for in the start of the year. And finally, the elections were concluded very peacefully. Nobody questioned the victory of our new president, Rodrigo Duterte. So it was a very well-accepted victory. So very peacefully concluded elections. So I guess the question right now in everybody's head, will the market continue to do well? We believe that it will. And we'll talk about it one by one. First, we'll talk about why we have a favorable view towards our new government. And then next, we'll talk about the long-term favorable outlook of the Philippine economy. Okay, one of the things I'd like to point out as far as our new administration is concerned is that it is a very lucky administration because it will be starting with a very strong balance sheet. Okay, so in the past, of course, we've always heard how kawawa naman the government, they have so much debts, most of the budget is used towards paying debts, the government doesn't have money. Well, this time around, we don't have the same problem. As you can see, the debt level of the government has been going down. So, government debt to GDP, as of the end of last year, was only 45%. Okay? And then, the primary balance is just a measure of how much revenues the government has on top of its day-to-day expenses. And as you can see, they have more than enough revenues to cover the day-to-day expenses. So very strong government finances. In other words, they don't have to keep on borrowing. Okay, and aside from that, during the past 6 years, during the Pinoy administration, we were lucky enough to enjoy 10 ratings upgrades. Okay, and because of that, you can see how interest rates have gone down. Our 10-year bond rate is at around 3.9%, 4%. Okay, so this just means that if ever there are investment opportunities, our government is in a very good position to actually borrow and roll out these new projects that will help the economy grow. So very, very strong foundation for our new government. Okay, and what about the Duterte administration? Why are we quite positive about this? They came out with a 10-point socio-economic agenda. And the first 6 points are more focused on the economy. So, this is something that you can read on your own, but the reasons why we're excited about it is, first of all, you will notice how he talked about continuing and maintaining the macroeconomic policies of the Aquino government. So I think in the past, there were concerns that he would not continue and maintain, okay, because he's not an administration candidate, but at least he will, no? So this brings less uncertainty. But the other point that I'm really excited about, or why we're really excited about, is infrastructure. Okay, so it's point number 4, accelerate infrastructure spending to account for 5% of GDP, with PPPs playing a key role. So we'll talk about this in more detail. Why are we very excited about this point? Okay, if you look at this slide here and the WEF Global Competitive Index, you will notice how our rank in being competitive has improved significantly since the start of the Aquino administration. From number 87, our rank right now is number 47 in being competitive. But notice how our infrastructure has only improved by 8 points or 8 ranks. So this just goes to show that infrastructure is a low-hanging fruit. If we work on improving our infrastructure, definitely there is so much more room for our overall ranking in terms of competitiveness to improve. Okay? And again, what's great about this new administration is that, in 2010, when Pinoy first talked about infrastructure and PPPs, there was no framework to speak of. So they really had to do a lot of work. But now, the new administration is actually inheriting a very rich pipeline of projects. Okay, so the past administration was only able to roll out 12 projects in 6 years. But the new administration is saying that they will roll out 17 projects in 18 months. And it's actually easier for them to do it because right now, there are already 14 projects in the bidding stages. So the value of these 14 projects is 459 billion or 3.4% of GDP. And aside from that, there are 5 more projects that are already for NEDA board approval. So that's just one step before it goes to the bidding stage. So maraming pipeline, okay? And the good news is the government is trying to refine the process further such that the time it takes from project proposal to award of contract will be shortened to 18 to 20 months from 29 months previously. So that's one of the reasons why we're excited. And also you should notice that the first few projects will be airports. I think this is also very exciting and in line with the new administration's focus on rural development. Because one of the fastest ways by which you can develop a rural area is through tourism. Okay, so it will be very good for tourism in the country. Okay, so the next 4 points of the economic agenda would involve social protection, healthcare, education. Okay, and the reason why this is important is because, as I've said in our previous presentations, the Philippines had just entered the demographic window last year, no? And this is, we're in the early stages of the demographic window, and this period will last for around 40 years. Okay, so the way you will maximize this demographic window is to make your population very productive through education, no? And to make sure that everybody's healthy so that everybody will contribute. So the country really has a very attractive demographics. So many economists have said that, this is something that nobody can take away from us. No matter who the president is, this is something that we will take advantage of and enjoy. Okay, population growth 1.6%. So as a business, you don't have to do anything. Your market just continues to grow every year. Median age of 23.2. The implication is, of course, at 23 years old, the earning power has not yet been maximized. You will still continue to earn more money going forward. And of course, your demographic window has only started. We're just beginning. During that 40-year time span, you have the working population growing by 48%. So really, very exciting times for the country. We just have to find a way to maximize this period where economic growth will be very fast. Okay, so other reasons why we're excited about the long-term prospects of the country. We are a domestically driven economy, as you can see. Local consumption accounts for around 66%, 67% of the economy. Okay, and this part has been very resilient. I mean, you look at the chart here since 1999 of the domestic consumption. It's always above zero. And right now, you notice how it has, the growth is accelerating at the 7% level. Okay, and investments in the country are picking up. Okay, people might worry about a bubble or overspending in capacity, but if you look at this fixed capital formation as a percentage of GDP, it's just at 22%. And 22% is actually very low compared to our ASEAN neighbors, because Indonesia is doing 33% and Thailand 25%. So still much room to grow for investments. However, that said, there are some short-term risks that we would like to highlight. Okay, so the first one would be possible ballooning of the budget deficit of the government. Okay, so if you read the papers, one of the things that they talk about as far as the budget is concerned is to potentially increase the deficit to around 3% of GDP. So in the past administration, in the Pinoy administration, the deficit has always been, they do their best to keep the deficit at 2% of GDP. Okay? And the past few years, it has been much less than 2% of GDP. So the problem is, if the budget deficit exceeds 2%, becomes 3%, or maybe if they miss the 3%, it goes to 4 or 5, there is a risk that our credit ratings will deteriorate, and this would lead to higher interest rates, which wouldn't be good for the economy. However, we did the computations. We believe that a 3% deficit to GDP is still acceptable. So if the government indeed comes up with a 3% deficit to GDP ratio, our debt to GDP will still be maintained at around 45% to GDP. So a 3% deficit to GDP is still within acceptable limits. Okay, and we are quite hopeful that the government will indeed come out with this, successfully implement new measures to increase taxes, such as improve collection efficiency, Okay, di ba? Ang ating tax collection to GDP is only 14%, despite the fact that we have one of the highest tax rates in Asia. So they're now talking about improving the efficiency of collection, and they're also talking about some new excise taxes. So, you know, based on initial computations, the additional revenues are expected to offset the cuts from, or the reduction in revenues from potential tax cuts and increased spending. Okay? So another risk that we see is the fact that valuations are quite elevated, and this is because people are already very excited about the Philippines, very excited about the plans of the Duterte administration. Okay, so one of the things we did was we computed for the PE ratio of the PSEI, and we're trading at around 19 to 20 times PE. So during the past 10 years, you will notice that this level of PE is on the upper end of the range already. Okay. Although, you know, we don't think that this is excessive, definitely it's not cheap either. And we did a bottom-up targeting for the PSEI, and our end 2017 forecast is 8,400. So from 7.8 to 8.4, some people might no longer find this attractive. They might find the upside to be quite limited, no? It's less than 10% if you think about it. So medyo manipis na, because people are pricing in very good things about it. And what are the risks about when valuations are expensive? Okay, further upside will largely be dependent on earnings growth. Okay, so if companies miss these earnings growth targets or the earnings growth expectations, you will see significant sell-offs. Okay, people are already pricing in attractive growth. Okay, so for example, to make it more concrete to the investors, think about PLDT and URC during the last earnings season. Both of them came out with disappointing results, and of course the share prices of these two companies have been battered significantly. So that's the risk right now, because everybody is already pricing in positive developments. And of course, since valuations are attractive, there is a greater risk that companies would do share placements. So you will notice that during the past 4 months, there were actually 4 companies that did share placements. You have JG Summit, CNPF, AEP, and GT Cap. So there is a possibility that you would see more companies doing share placements because of elevated valuations. And we know that when they do share placements or rights offerings, share prices initially go down. And they get sold at a discount. So that might be a negative surprise for investors holding individual stocks. Okay, then of course there is the possibility that we would see some disappointing short-term economic results. So one of the things that we kind of noticed is during the first 6 months of an administration's term, government spending typically slows down. Okay, this is very normal because it takes a government a while before it can execute on new plans. I mean, even though the plans are very good, you still have to go through a period of planning stage. And this is not only true in the Philippines. The same happens in other countries, like in India, you have a very popular new prime minister. In Indonesia, of course, you have and the new president is also very popular. But then again, the first few months have been quite disappointing because it does take a while for the government to actually implement the new policies. Okay, so there is a possibility that we would see the same in the Philippines. Okay, that said though, we don't expect the PSEI, if it corrects, well, it's now undergoing correction, we don't expect to see significant corrections. First thing is the foreign investors have actually not fully come in yet. So you can see last year, up to the early part of the year, we saw net selling from foreign investors of 112 billion. For the year-to-date period, net foreign buying is only 57 billion. Okay, so still room for more foreign buying to come in. Okay, and we'd like to inform everybody, or we'd like everybody to be mentally prepared to actually buy this market when it corrects. So notice how the market has gone through several corrections the past few years. The first is the end of the Pinoy honeymoon period in 2011. So you will, in early 2011. So you will notice during that point in time in 2011, we had a 1-year consolidation when the initial GDP came out, and it was quite disappointing. Government did not spend. And then people were very disappointed with the PPPs because people wanted the government to bid out the PPP, but there was no PPP to speak of for almost the whole of 2011. The only time it came out was in December of 2011, and that was the time when the market started to recover. Okay? Then, of course, you had the US taper tantrums in 2013 when they first started to talk about the withdrawal of the quantitative easing. Then last year, we had the contagion affecting the Philippines due to this emerging market sell-off. Okay, but notice that, you know, if you had bought during these times of correction, it was actually a great opportunity for you to make more money. Because I remember in 2011, for instance, during the start of the year, people were also talking about how expensive the market was. But of course, from the 3,000 level, or maybe 4 or 5 in early 2011, the market is now at 7,800. So the market has gone up quite significantly. So, you know, let's not be afraid. The Philippines' long-term outlook remains very positive, and corrections really are opportunities to buy this market at a more attractive level. Okay, so this is everybody's favorite slide. What are our stock picks? So these are more thematic picks for us. In light of the policies of the Duterte administration, what do we think are sectors or stocks that would benefit? Okay, so first, we're positive on infrastructure. The government has talked about how it would increase infra spending and do more PPPs, and of course, attract more foreign direct investments. So we believe some ways to play this would be Metro Pacific, Metrobank, BDO, so we'll talk about them one by one. Then again, earlier on, we talked about how positive we are about tourism. Okay, since 5 out of the next 17 PPPs are airports, and the government has talked about its focus on rural development and inclusive growth. Then we're also positive on consumer stocks. Okay, this is because of the country's favorable demographics, potential tax cuts, and improvement in social protection programs. Okay, stocks we like would be SM, DNL, CNPM, CIC. Okay, right now we're also seeing some rotation into smaller cap stocks because of the more expensive valuations of big cap stocks. Okay, so for this particular play, we like East, West, and EI. And of course, our bottom-up picks would be FGen and EDC. Okay, we'll talk about them in more detail later. Okay, so MPI, why do we like MPI? You know, MPI is known for its focus on infrastructure development. It has been a very active bidder for these PPP projects. Okay, and one of the things we like with the company, it has strong financing capability. And of course, the subsidiaries are benefiting from growth opportunities, like Maynila, which is one of its subsidiaries, still has an underserved population in their concession areas. And Meralco is still benefiting from rising power demand. Okay. However, again, we talk about the risk. Note that Metro Pacific is subject to regulatory risk. There is also risk of capital raising, okay, in case the company wins big ticket projects. And at this point, we find the stock a bit expensive. Nevertheless, maybe we wait for a correction and it could be an opportunity to buy the stock at a cheaper level. Okay, Metrobank, of course, another way by which we can participate in PPPs would be through the banks. Later on, we actually have the privilege of having somebody from BDO to talk about their own bank. And they'll talk about how these new infrastructure projects will lead to higher demand for loans. Okay, so Metrobank is one of the big three banks, and because of their size, they should benefit from PPPs as well. And from the earnings perspective, it is really coming from a low base. So we're quite optimistic about the future earnings growth prospects. Capital adequacy is very high already since it did the capital raising activity last year. Okay, and valuations are very attractive. It's currently trading at only 1.2 times price to book value. The industry is doing 1.3, 1.4 times. Okay, I think the reason why Metrobank has been very weak recently is because it came out with below expected first half profits. Nevertheless, we believe that this is just a short-term opportunity. It's a short-term correction because if you look at the loan growth, it's actually quite healthy. I think it's a shift in strategy that caused earnings to be disappointing in the short term. Okay. The other risks are more general market-related risks, such as the margin squeeze due to excess liquidity and tighter regulations from the BSP. Okay, BDO. Okay, also, actually BDO is the largest bank, and it's the, of course, will benefit the most from these PPPs because of its size. And it has very strong core operations. 86% of revenues are recurring in nature, meaning these would be your fee-based income, net interest income, so they're less subjected to volatility caused by trading income. And it enjoys the largest economies of scale because its current account and savings account deposit levels are highest percentage of total. Okay, so very low cost of funding for them. Okay, the major risk facing BDO is capital raising risk because its capital adequacy level is a little bit low. So that's just the major risk that we see as far as BDO is concerned. Okay, Cebu Pacific, we like this company. It's a market leader. Okay, its market share is around 59%, leading to economies of scale and pricing power. Okay, they're more efficient compared to their other competitors, and of course, they also are trying to capitalize on opportunities by expanding their ex-Manila hubs starting 2018. Okay, and they're also a beneficiary of low oil prices. So profitability has increased quite significantly. And the good news is valuations are very attractive. The stock is trading around 6 times, 7 times 2017 earnings versus other low-cost carriers in the region, which is trading at 10 times, 11 times 2017 earnings. Okay, just some things to point out. Cebu Pacific is actually very vulnerable to Forex. If the peso weakens, earnings will be negatively affected. If oil prices go up, of course, earnings will also be negatively affected. And of course, there is always this threat of competition due to falling oil prices. And Ayala Land, well, among the property companies, this is one of the property companies that we believe will benefit from increasing tourism because the company has talked about growing their hotel portfolio. But aside from that, Reasons why we like Ayala Land include its very strong brand name, okay, and how aspirational it is for Filipinos to own an Ayala Land property. They're also targeting to grow their profits by a compounded annual growth rate of 17.8%. And one of the reasons by which they plan to do this is by increasing their leasing portfolio, the malls and the offices. And it also has a huge land bank all over the country. Okay. So the risk, valuations are a bit on the high side. They always trade at a premium. Compared to other property companies, they have more debts, okay, and of course, capital raising risk. Okay, Robinsons Land, we also expect Robinsons Land to be a beneficiary of growing tourism. Okay, it plans to expand its hotel portfolio by a 13% compounded annual growth rate. Okay, and it's considered to be the most defensive property company. So as you can see, 75% of operating income is from its malls and offices. Okay, problem is, of course, valuations are a bit expensive and its residential business is peaking at this point in time. Okay, SM. Okay, for consumers, we like SM. Subsidiaries are market leaders in industries where they operate. So, of course, among the subsidiaries of SM would be BDO, SM Prime. So these are dominant market leaders. Like SM Prime is a dominant market leader. They're highly geared towards the consumer sector. Around 49% of income is from retail and mall business. Okay, so if you want to play on the Philippine economy, which is like 70% consumer spending, one way by which you can participate is by buying SM stocks. Another thing to be excited about as far as SM is concerned is the merger of SM Retail. And this will significantly expand their exposure to non-food related brands. Okay, risk would be intensifying competition and fair valuation. Another stock that we like for the consumer sector is DNL. We like it for its strong track record of growth. Okay, it's been going to more specialized, higher margin products. So as you can see, its past 3 years, recurring profits have increased by a compounded annual growth rate of 25%, and high margin products now account for 61% of revenues from 58% in 2010. We're also very excited with its partnership with Ventura, as this would improve its ability to service Asian food markets. Okay. And another stock that we like is CMPF. Okay, so this is Century Tuna, okay, company behind Century Tuna, Birch Tree in Argentina. Okay. So it's also a market leader for canned tuna or canned fish at 87%, canned meat 37%. A favorable outlook for milk because consumption of milk in the country is still very low. So if as Filipinos become richer, you will see more people consuming milk. Okay. And we're also very positive about its coconut business as this will add around 10% to its earnings annually. Okay. And another exciting catalyst for the stock is the secondary share offering, which will boost its free float from 16 to 21%. So although this stock has been listed for a long time, the reason why we believe it will price more higher is because of the increased liquidity that will result from the secondary share offering. Okay, next, another consumer stock that we like is CIC. Okay, it's a market leader in air conditioning and refrigeration. Okay, and the outlook for both is very positive. As Filipinos become richer, of course, one of the first things that they will buy is air conditioning and refrigerator. So believe it or not, around more than 60% of Filipino families still don't own a refrigerator and an air conditioner. So knowing that, that they will become richer, of course, that will be one of their first priorities in terms of things to buy. And we're forecasting profits to grow by a 3-year compounded annual growth rate of 26%, and valuation still relatively cheap at around 17 times PE. Okay, East West Bank. So this is one of the less liquid or smaller cap companies that we like. The reason why we like this bank is because of its strong exposure to the consumer segment, which is actually a growth segment for the banks. And margins are more attractive. And we are quite excited because we believe that the market is actually not looking at this stock. This is a not very actively traded right now. It's only trading at 0.8 times price to book. Okay. This stock has been battered significantly, but we believe that earnings are already turning this year. First half earnings have been very good because the drags to earnings the past few years have already reversed. Okay. And another stock that we like is EEI. Okay. Of course, we expect this stock to benefit from greater focus on infrastructure. I think one of the reasons why this stock is being battered is because of its exposure to Saudi Arabia. Okay, and this Saudi Arabia business continued to drag first half earnings. However, Saudi Arabia is now down to 12% of profits, and the stock remains very cheap. It's only trading at 9.8 times 2016 PE. Okay, so this is a stock that actually FGen is a stock that we have been recommending for a long time, and some people might already be very impatient with this stock. But we believe that the wait is almost over because one thing is it faces less regulatory risk at this point, knowing how the government is more focused on clean energy or better environmental standards, and FGen is focused on clean energy, the natural gas, and then of course through ETC, renewable energy. And the reason why we think that the wait is almost over is because coal prices are actually recovering in the global market. And one of the reasons why FGen is not doing so well is because their ability to lock in new contracts at a good price is being hurt by low prices of coal. Because imagine you're competing against coal-fired power plants that enjoy low energy prices at this point. Okay? So, with coal prices now recovering, they will be able to lock in new contracts at a higher price. So, same argument for EDC. Of course, it's also a clean energy company. In fact, it's a renewable energy company. Less regulatory risk, and of course, the outlook is brighter because it will be able to lock in future contracts at a higher price, and valuations are attractive for these two stocks. Okay, but note that if you buy FGen or EDC, you buy only one because EDC is a subsidiary of First Gen. So if you buy both, you kind of face the same risk. So pick only one. Okay, so before I end, just some risk management strategies. Okay, just want to reiterate and remind everyone of these. First, when you invest in the market now, please have a long-term view. Our outlook is very positive in the long term, although we may have may be encountering some short-term correction or short-term risk. The long term remains very positive. So when you invest, don't expect. It's best not to have an expectation of positive short-term view. Next, adopt a peso cost averaging strategy. The market is, of course, very difficult in the short term. Using a peso cost averaging strategy would allow you to improve your buying price. Corrections are opportunities to buy. Okay, so when the market corrects, don't be afraid. It is your opportunity to actually make more money in the longer term. And then finally, diversify to protect yourself against risk. So now is not the time to make concentrated bets. Okay, it's not like in the past where anything you buy goes up. A lot of companies face risk right now. So you should invest in more than one stock or consider doing a combination of stocks and mutual funds. So thank you very much and enjoy the rest of the afternoon.
Thank you very much, Philippine National